coronavirus cases per day. So what a difference 12 months can make. And yeah, it's been a very tumultuous period, and thankfully for Australian business and our economy, we're in a better spot than we were 12 months ago with the uncertainty that we faced. So it's a pleasure to welcome current clients, members of the BlueRock community, and potential clients of BlueRock also to the webinar today. Hopefully we can provide some insights into our thinking around where the world is at from a macroeconomic perspective and what that means for investment markets and navigating the coming 12 to 24 months. We're no doubt living in a world of extremes. So we'll talk a little bit about our thoughts today and how that might guide your thinking and certainly our thinking in portfolio construction. So to introduce today's speakers, let's move across to the next slide, please, Gareth. For those that don't know me, I'm the Managing Director of the Private Wealth team. The private wealth business within BlueRock is quite diversified across different areas of advice that we provide. And importantly, we're here to talk today specifically about the investment part of what we do. For those that have joined our webinars previously or attended events at BlueRock, Craig Ferguson won't be a stranger, but for those who don't know Craig, Craig's been part of the investment committee of BlueRock for coming up to 3 years now, has extensive experience in navigating the global macroeconomic landscape, consulting to a range of family offices and businesses, and working with some pretty serious investors like the Future Fund as an example. So we'll hear from Craig around his views on asset allocation and the macroeconomic landscape, which obviously importantly guides navigating the risks and opportunities that are currently in front of us, and certainly that have been there for the last 12 months. A new addition to the BlueRock Private Wealth team as of February, after an expansive search to find the right person to fit the role. Gareth Maid joined BlueRock the 1st of Feb as a director, specifically focused on the investment side of the business. Gareth now chairs the investment committee. So Craig, Gareth, myself, along with a couple of others, form the BlueRock investment committee. We meet formally monthly, but various discussions happen. Last year, it felt like we were meeting every second day as the world was changing pretty quickly. Gareth brings about 20 years of experience to the BlueRock investment committee into BlueRock, specifically in investments, and over the last 5 years working primarily in the family office space, helping construct and run portfolios. So it's great to have Gareth join the team, and Gareth is going to talk more specifically about the macroeconomic views that we have on the investment committee, and specifically how that translates into portfolio construction. So the session will formally run for about 30 to 40 minutes. As we go, please post questions into the chat function, and I will pick them up as we go and answer them along the way, and there'll be an opportunity for Q&A at the end. If there's any follow-up questions or thoughts regarding today's session, please feel free to reach out, and there'll be a follow-up email, and we'd love your feedback off the back of today's session. So thanks again for everyone for joining us, and I'll hand over to Craig.
Thanks, Adam.
Before I do, I don't want you to go through the disclaimer, Craig. That's for me to finish off on. So yeah, basically all the information that we go through today is general in nature, and if you have any specific queries regarding your personal circumstances and how this information relates to you, obviously you've got a good team of advisors here at BlueRock to help you with that. Yeah, I'll hand back over to you now, Craig, to run through your views.
Right, thanks, Adam. I really wanted to start with, and Gareth, I've just tried to request control there, but for whatever reason, it's not coming through my end. I think you're on mute, Gareth.
You should have control there now, Craig.
Okay. Just move.
Have you got that?
Coming up, I think.
Okay.
No, for whatever reason, it's not doing it. If you just want to move through the slides, Gareth, for me, that's fine.
Sure.
So I thought it'd be useful to, before Gareth speaks about some market-specific things around the portfolio and around equity markets, I thought it'd be useful for us to have a look at not just where we're going over the course of the next couple of years or the course of this decade, but also look at some history going back over the course of the last 3 or 4 decades, just to kind of condition the framework for how we think about investing and where we see opportunities in the portfolio. One of the outstanding developments over the course of the last 40 years has been the peak in inflation and the peak in bond yields, which you can see in this chart here, which occurred between 1970 and the early 1980s as we had a number of oil crises and as commodity price inflation accelerated. But then for the last 40 years, we've had a scenario where 10-year bond yields in the US and in Australia have continued to decline from about 15% down to where they currently are now, around 1.75%. That decline in yields, as you can see here on the right-hand side, in terms of those bullet points, says that it benefits long-duration assets, things like tech that don't tend to pay dividends or have income. And the reason it does that is because as bonds which provide coupon income tend to provide less of it, those things that it's compared against, such as tech, for example, do particularly well. As a result of that, you get one-off revaluations across a number of different asset classes, not just in terms of bonds, but also in equities, corporate credit, which is bonds, things like Bitcoin, which are now starting to unfold, and extremely large and sustainable rises in things like housing. Also, one of the things that happens is that when you get bond yields so low, and we all know that the cash rates here in Australia are around 0, it also encourages people to take on a hell of a lot of leverage and a lot of debt. And that leverage then tends to push up the prices of those things like equities, credit, housing, and other things. And it also leads to exceptional overvaluation in those asset classes. The single lesson, though, over the course of the last couple of decades is that overvaluation on assets never, ever is permanent. It tends to be transitory. So that's one of those things that I think has been really key in terms of conditioning why equities are where they are, why housing is where they are. And the key going forward, one of the things we're trying to answer is whether this trend of falling bond yields and 0 cash rates will continue going forward. One of the themes that we've been playing with over the course of the last year is that inflation will actually start to rise. Bond yields tend to be above inflation. So if, for example, inflation's 2%, then normally a 10-year bond yield would be 2.5 or 3%. So a premium to inflation. And if inflation actually starts to rise, as we think it will because of excessive monetary and fiscal stimulation of the economy, which is what we're seeing now, then we may actually get a scenario where bond yields actually start to rise. And that will potentially reverse some of the overvaluation and excess leverage that's evident in the equity market. Gareth will talk to this a little bit and provide some indicators around that. But I think it's really interesting to think about what's conditioned us for the last 4 decades and what will condition us for this next decade. And my sense is that this next decade will be an inflationary decade where wages actually stop falling and start to rise, commodity prices start to rise, and bond yields actually start to not just go down like you can see in this arrow, but then actually start to move up. Gareth, if you can just move to the next slide, please.
I think you may have control now, Craig. Do you want to try that?
Okay.
Do you want to try control? All right, I'll take over.
Yeah, I think so. I don't know why for whatever reason it's not working. So I think that scenario is a really interesting one going forward over the course of the next couple of years. And if we can just go to the next one, Gareth, if you can. The other thing also is that there's back one, sorry. There's a change in a number of long-term trends that have powered equity markets over the course of the last 3 decades as well. And over the course of the last 2 or 3 years, some of these trends have become far less convincing and are actually showing signs of reversing. So for example, strong global growth, which has been a factor since 1980, it started to, and obviously last year we had exceptionally low global GDP growth and recessions across the globe because of COVID. But we've also started to see a slowdown in the trend nature of global growth. Demographics have been very, very positive for the last 3 or 4 decades, but now we're starting to see a scenario where the retirement of the baby boomer generation will actually force the labour force to decline, may see wages start to increase going forward, but also the decline in the labour force means less productive capacity and lower growth, whereas higher wages tend to mean higher inflation. So that kind of brings about the potential for an environment of stagflation, which is what we saw in the 1970s and which some of us would remember reading about in textbooks when we went to university. Global trade's been very strong for many decades, but we're starting to see friction over the course of the last couple of years with Trump putting tariffs on Chinese exports. They remain in place. We've seen record growth in China. Some of that has been more moderate and population declines in China but may play a role there going forward. We've seen unlimited room for debt growth over the course of the last 3 or 4 years, but 3 or 4 decades. But going forward, room for further debt will become less obvious. Economic volatility has certainly been the largest we've seen over the course of the last 2 years compared to the last 3 decades. And probably really importantly are the last 3 or 4 factors, which is we're starting to see an increase in geopolitical instability, the potential for a decline in the corporate profit share, i.e. the profit margins that corporates tend to achieve from producing goods, change in that long-term interest rate structure, and then also almost constant technology disruption in particular different areas. So this is quite a different framework for investing going forward, and it's one that says that a lot of the themes of the last 3 or 4 decades probably won't apply going forward. If we just move to the next, please.
Sorry, gentlemen, I'm just having a few technical issues. There we go.
There you go. So the interesting thing around demographics is that, and actually, Gareth, can you possibly go back to the previous slide if you can? I think we've just slipped through to actually, no, back down, sorry. That's the one. What we're actually seeing and what we will see over the course of the next decade is quite a dramatic change in demographics. So this chart looks at the expected working age population of emerging and developed nations. The blue bar look at that previous 35-year period from 1980 to 2015. And you can see that across developed and also emerging market economies, you had very, very strong growth in working age populations. However, the grey bars look at the period from 2015 to 2025, and if we extended that out to 2030, we have a similar sort of scenario that working age populations will decline in China and Italy and Japan, Germany, and be very, very slow in places like US and Australia. Now, if you think of what it means less workers are available to produce goods, so it means lower production. It also means that we may have a scenario where wages actually need to start to rise going forward rather than continue to fall. So again, this reinforces that stagflationary theme. Gareth, if we can just go to the next slide, please. You can see that here as well over the course of the next 10 years, with the working age population expected to also decline in South Korea. But the interesting thing about it is that if you look at those bars on the right-hand side, you see that the emerging market world still has the most strong and most robust population growth. So if you look at the portfolios that I've been advocating to BlueRock and that BlueRock has in play, we often, and indeed we have over the course of the last couple of years, have had significant exposures to emerging market strategies in portfolios, simply because those are the places where there's still going to be stronger growth, and stronger growth tends to lead to stronger profits and higher share prices. Next slide, please, Gareth. The other thing also is that many things in terms of investment themes have been changing over the course of the last 3 or 4 or 5 years. And you can see that from the sort of things that people are writing in terms of books. So down on the bottom left there, you can see what we've just been talking about, a book about the Great Demographic Reversal, which is how ageing societies tend to produce less but have higher wages and be inflationary. We see some others down there about the rise of robots, the great level of violence and inequality, which we've seen in the US economy over the course, and in the US news flow over the course of the last year. China's rise and what that means for the US and relative power games destined for war. You can also see other things around the deficit myth and green swans, so green technology and things like that. Investment themes that are becoming far more popular as climate change becomes more front of mind for people. In addition to that, you'll also start to see in some of the portfolios more of those, some of these themes kicking into play. For example, technology around robots, impact biased investments, for example, in the portfolios. And these are the sort of things that we're starting to incorporate into the portfolios that you see. Gareth, next one, please. The other thing also that I wanted to focus on a little bit was the fate of Australia given the course of COVID over the course of the last 12 months. Traditionally, Australia, as you can see from this yellow chart here, has had the strongest population growth of most of our global peers over the course of the last 30 or 40, 50 years. One reason for that, and indeed a strong reason for that over the course of the last 15 years, has been the big jump in migration. And we had 1.5 to 2% population growth as a result of that. That tends to imply strong GDP growth. But if you look at what's happened with COVID and migration restrictions and mobility restrictions globally, that population growth has significantly declined from where it was. So, if I was to ask you whether Australia was to continue to have really strong population growth and strong growth going forward, most of you would probably say yes. But the reality is if you don't have strong population growth, you tend to have low GDP growth going forward too. Next slide, please, Gareth. So if we think about GDP, there are two components to it. It's population growth, as I mentioned before, but also productivity, i.e. how much people produce from set portions of capital or labour and technology. So essentially those two things equal GDP. If population growth's weak and productivity isn't strong, then you tend to get a scenario where GDP growth tends to be sub-average or sub-normal. And you can see in this chart over the course of the last 60 years, the average of GDP rate has tended to moderate, and certainly the range has declined over the course of the last 20 or 30 years, but also the average level, which is that red bar, has tended to shift down. My sense is that over the course of this next decade, that red bar of average GDP growth will actually slip down even further. Why? Because we've had to invest in other things which are costly, around resilience issues in health, global supply chains and cybersecurity. We know that there are geopolitical issues and they're starting to produce industry changes in industry policy, trade barriers, reduced international people flows. We know our population is aging, and we also know that there are going to be some costs. There will be long-term benefits, but there will be also some costs in terms of environmental issues around climate change, circular economy and land degradation. So this population and productivity argument tends to be one which suggests slower growth going forward. Slower growth tends to mean slower corporate profits. slower corporate profits and lower earnings tends to mean less upside for equity markets over a very long time horizon. Next one, please, Gareth. So one of our theories is that inflation will start to return. And over the course of the last 100 years, we've tracked inflation here. You can see that it goes in distinct cycles, you know, of about 40 or 50 years, with the rise into the 1970s and 80s, the first upward inflation cycle, and then the disinflation cycle following ever since. Some of these things that we've spoken about are going to produce more inflation. So deglobalization and trade barriers, productivity inhibitors. You know, for example, if you can't get enough people to produce enough goods, then you have to pay people more in order to be able to produce. We've also seen a lot of underinvestment in commodity markets, for example, and reduced supply. That's meant that commodity prices have gone up. The chance of an arms race will probably be quite high, given the competition we're seeing between Russia, China, and the US. And in addition to that, not only are we seeing tech monopolies, which tend to produce higher than otherwise would be the case prices, but we're also seeing excess liquidity. So, for example, you know, the fiscal policy from Australian and global governments, and also monetary policy from Australian and global central banks, has tended to mean that we've seen a hell of a lot of excess liquidity in the system, and that excess liquidity is chasing a limited amount of goods. That tends to be inflationary. Next one, please. The other thing, and the challenge for Australia, is that we tend to still be an economy that in terms of the goods that we produce, they tend to be relatively non-complex. So you can see a range of different economies here over the 5 major geographic groupings. And you can see that countries in Africa, America, Asia, and Europe tend to be a lot more higher in terms of their value add and economic complexity of the goods that they produce. Australia, as we know, tends to be a commodity producing economy. So the big challenge for us is that we've got to try and introduce some complexity into the way we produce commodities, and also look at other different areas such as the STEM areas, for example, in order to be able to grow our GDP growth at stronger levels. Next one, please. The other aspect of, and the other flow through from what we were talking about tends to be into not just equity prices, but also into housing prices. So as you can see here in Australia, we've seen a significant rise in house prices relative to per capita income over the course of the last 45 years, such that our house prices have gone up far greater than what we've seen globally, if we look at a whole range of different peers. One of the challenges going forward, and I think in the short term, in the next 12 to 24 months, we'll see house prices rise significantly due to some of the fiscal stimulus and home buying packages that are still in play, and the fact that interest rates will stay low for another year or two. But once bond rates and inflation starts to rise, and the pressure come 2023 or 2024 may be on the RBA to actually raise rates rather than keep lowering them, and indeed having them interest rates at 0 now means that interest rates probably only have one way to go, and it's back up over the medium term, as long as you get inflation driving them. So higher interest rates and higher bond yields will potentially, not so much in the next 12 months or 24 months, but in 2 to 3 or 4 years' time, be a headwind for the Australian housing market as well. And that bubble, which is definitely a bubble in my view, will have certain risks for the Australian economy when it does start to deflate. Next one, please. The other thing that I really wanted to talk about today was that we're living through a period currently where we're actually seeing the decline of the world's major superpower for the last 70 years, which is the US, and the rise of China. You can see that on that left graph there. There are a whole range of different things that dictate how powerful a country is. On the right-hand side, you can see that things like trade, output, innovation, the military, those are all the sorts of variables that dictate how powerful a country is. I mean, if we put them all together, we can actually see that Over the course of the last 10 to 20 years in particular, we've seen a significant rise in the power of China relative to a whole range of other different countries, another 11 different countries there. And US power has actually slowly been declining after reaching its peak in the 1960s. Typically, one of the problems that tends to occur when you get a great power being challenged by another, and historically this has always been the case over the course of the last 500, 600 years, is that you've tended to have military conflict and war. So for example, if you look at that graph on the left-hand side, you see the black line being the UK and the blue line being the US. You can see around the 1900s, we did get conflict around that time. In addition, the orange line, the Netherlands, for example, crossed over in terms of being the most powerful country relative to the UK. For example, back in the 1700s, we saw numerous wars between the English, the Dutch, the French. We also saw conflicts with Japan as well, obviously in the mid 1900s. So I think the key issue going forward is whether, and it's a key one for us, is whether the continued rise of China and the continued slide in American power does create conflict. The most obvious place for that is Taiwan. It does appear that China does want to proceed with unification in Taiwan, and is starting to set some time limits on that. For example, 2025. As a result of that, the US is trying to respond. So we have a choice here in Australia whether we choose between the US and China. One of the things that we can do is to seek safe harbour alliances with other Western liberal democracies, and we're starting to see that occur. We also need to diversify our trade links. One other thing we can do is also use our advantages, such as commodity markets in coal and iron ore, as a lever of pressure against China, but we haven't yet done that. But the interesting thing going forward is that this closure of the gap, the great power gap between US and China, is something that hasn't been an issue for the last 30 or 40 years, but it is going to be an issue for this decade, and it's one that will create a lot more uncertainty. Next one, please, Gareth. The other thing also is that there's a really interesting dynamic underway in the US, which is that the US election and the ascension of the Biden government, Biden team to government, is really focused on key things around inequality, environment, race, and wages. You can see on the left-hand side what an issue this has been for the US economy, and it's one of the reasons why we're also seeing a decline in US great power, because the income and the wealth in the US is not being spread evenly. You can see that on the left-hand chart there, because the top 1% now in 2020 tends to own about 18% of US wealth, whereas the bottom 90%, which is the red line there, owns about 27%. That gap is closed. And the last time that gap got to that sort of level was around the Depression back in the 1930s, and also a period of war and conflict. If you look at that second chart there, you can also see that the top 10% of US income earners own about 45% of wealth, and the bottom 90% about 55%. So that gap has continued to close. The key going forward as to whether that gap will remain that wide or continue to narrow is the charts on the right-hand side. And this is where what Biden's doing is really, really important, or what he may plan to do around wages. So the blue line there shows US compensation of employees as a percentage of the US economy. We can see in 1975, it was around 57%, but currently it's around 53%, which you can see to the right of that chart. You can also see that US corporate profits, which is the yellow line, tended to base at around 7.5% of GDP in the 1980s and 90s as wages started to decline, but then rose significantly when wages really collapsed over the course of the last 20 to 30 years. So essentially what's happened is you've seen a huge transfer of wealth from the man in the street, the man and the woman in the street in the US to the corporates. And as a result of that, we've seen a huge rise in the stock market. So if this changes, and if we get, for example, a doubling in the minimum wage from $7.50 an hour towards $15 an hour, which was what Biden argued in his pre-election manifesto, you could theoretically see a significant rise in US compensation of employees from around 53% back to 55 or 57%, and you would see a collapse in the US corporate profit margin. So this is one of those things that really has huge potential to change the landscape in the US. In addition to that, I haven't included other things, but when corporate profit share gets this strong, you then tend to get increased regulation of corporates. And we're starting to see that in terms of the technology companies. Why? Because they're making too much money. And the man in the street and the woman in the street are actually sitting there and saying, hang on, things aren't fair anymore. So this wage inequality is leading through not just to racial inequality, but it's also leading to a strong stock market. It's also leading through to the potential this decade for much greater regulation and therefore lower corporate profits in trend terms going forward over the course of this next decade. Gareth, next one, please.
Craig, just before you move on to the next slide, a question from the audience. From Liz, your thoughts on social media and tech companies and how they're influencing the power dynamics across the globe?
Thanks for that question. And actually, that's my last slide. So I think that's part of this story around the social media story is part of the story of increased regulation, not just because it is not just a story about monopoly power and about pricing power and high corporate profits. But one of the things that really became evident over the course of the US election was the power of social media companies to effectively censor Donald Trump with his Twitter and Facebook postings. That's something that really is not has not been taken well by the US political elite, whether you're Democratic or Republican. Lawmakers in the US like the notion that they set the laws, especially around social media policy, around media policy and other things that are important to the political system. And they don't like the fact that social media was able to essentially censor one side of politics because they didn't like the message. So I think, we're going to continue to see these sort of issues percolate going forward. And these are unpriced risks. The reality is that these risks are occurring at the end of a very, very long disinflation and lower bond yield cycle. And as a result of that, if the bond yield cycle moves higher, inflation moves higher, all of these assets are at exceptionally high valuation levels, indeed the highest we've seen for 30 years. And when some of these factors like rising wages, for example, greater equality rather than inequality, falling corporate profits and increased regulation start to kick in a gear, then you start to see a scenario where the prospect for the next 10 years for equities in terms of growth won't be anywhere near as strong as what we've seen for the last 10 or the last 30. I'll probably leave it there unless there's another question and maybe hand over to Gareth.
No other questions at this stage, but feel free to send them through, either related to Craig's comments or what we're about to hear from Gareth.
So thanks, everybody. Thanks for the opportunity to sort of virtually meet you for the first time, and particularly over your lunch break. So thanks for taking the time out. So what we look at in the investment committee is, what does all this data mean for the portfolios? What are we seeing going on in the marketplace, and how does that translate to asset prices? Now, really over the last few years, what we've seen is this fear of missing out. So, asset prices have been rising. People have been following their friends and family in behind them and saying, well, you've made 10% on your assets, I'm going to get it as well and make this easy money. Now, that's really been driven by the fact that we've got Tina on the screen as well. That, there is no other alternative compared to cash. I can't remember a time in my career when I've had clients ringing up with such regularity saying, look, I just got my rollover from my private banker or something like that. They're telling me what I'm going to get on my term deposit. It's only 0.5%. What other alternatives have you got out there? And invariably they end up in the equities market or in property or something like that. So there is no other alternative other than moving out of these, in inverted commas, risk-free assets, such as cash, term deposits and bonds, and being pushed into the market. And so what we've seen over the last few years, and particularly in the last 12 months, is as these forces are coming behind the market in order to support the market, a lot of speculations come into the market as well, resulting from technology and the likes of Robinhood and low-cost trading platforms and things like that. But you're seeing people punting their stimulus checks over in the United States, purely because they've seen what's gone in the market and this purported easy win. So, you know, you're seeing an explosion in the penny dreadfuls over in the United States. These are numbers that we've never really seen before out there in the market. Also, at the same time, we've got the rise of the special purpose investment companies over in the United States. What these are effectively is the cash box, where companies raise cash and say, trust us, we'll list this cash box, we'll then go out and find you a high quality asset in which you'll be invested and we'll deploy your capital. As you can see, this has been a huge explosion over in the United States. Some would argue it's a way of getting around the listing rules in the United States, but effectively there's no accountability or pricing in regards to these assets when you pledge your cash or capital to these portfolios. So what you're seeing is a disconnect between actual value and price. Meanwhile, what we're seeing through some of these professional fund managers is that we're seeing a statistical rise and an increase in the amount of risk these portfolio managers are taking inside their book as they're investing your capital and the capital of other people. And traditionally what you've seen is once the amount of risk in these portfolios gets to extreme levels, then we see markets start to roll over. You only have to align some of these market instances with what's going on in the market previously. And this is another indicator for us as to what's going on out there in the marketplace. So another signal that we look at is Buffett's GDP to market value indicator. Now, look, this isn't a perfect tool for us. I mean, you might look at it and say, look, every time it crosses the second standard deviation or gets close, I'm going to take all my money out of the market and I'm going to stick it in cash. It's not a perfect indicator of that, but what it does do is it really gives us a great sense of the overvaluation that's going on in markets. What we are seeing through this graph at the moment is that we're at effectively a statistical post-war all-time high for that valuation. The only other time we've crossed the second standard deviation was through the tech wreck of the early 2000s, and look, we got pretty close during the 1970s, and that rolled over and we had a bear market for an extended period of time. So on a valuation basis, on a speculation basis, we're starting to see the market at this huge frothy extremes. Now, what you might be saying to yourself is, well, I'm just going to go to cash. I'm just going to stick my money in the bank account, which we all know that you're not getting much income on. And I'm just going to wait it out, watch the market roll over, and hopefully I'll be able to get him back in at a cheap rate. The problem with that is that from a long-term perspective, you're going to get beaten down by inflation. If Craig and the investment committee are right, and we do see a rise in inflation, the fact that your money is sitting in cash accounts and term deposits and all that, and those types of asset classes, what this will mean is you get a physical erosion every year on the real value of your cash. So in the longer term, we'd like to see clients reinvested back in property and shares and those types of things, which do have a correlation with inflation and will rise in line with inflation or even exceed value inflation. But in the short term, we're really focused on defending the value in clients' portfolios so that when those opportunities do arise, we can rotate into those asset classes at the right time. So at the moment, we're a little bit underweight Australian shares. We've seen a massive outperformance, particularly in the small cap space in the market. I was looking at a manager this morning who returned in the last 12 months in excess of 100% on the investment of clients. Now, look, you're basing that against a 12-month performance when the market was an all-time low at the height of the COVID emergency, but 100% return on portfolio is just immense. So at the moment, we're holding a little bit of money back and really tilting the portfolios in line with value. What we want to see inside the portfolios are businesses that are creating revenue. In the last 5 years, or 5 or 10 years, the market has been really focused on these high growth tech stocks where they're able to leverage a balance sheet, get huge economies of scale, the likes of Amazon and those sorts of things. Now we're starting to see a return to the focus on, surprise, surprise, actual profit in businesses. And so there's been quite a significant rotation in the market. We've participated in that by moving clients' portfolios ahead of that. We're a little bit underweight on infrastructure. Infrastructure is an interesting one. Can be a great asset to be involved in a time of inflation. But again, we've got some concerns around the levels of gearing and the cost of gearing going forward, and that impacting the profitability of those assets in the short term. I guess that where we're really underweight and in line with Craig's presentation is we're very much underweight or in some cases out altogether of the bond market. You've got two dynamics that are going to occur here with the bond market. One is that you're going to sit on an asset that returns you almost nothing. If nothing happens to the bond market, you get almost zero return on your investment for potentially an extended period of time. But if the bond market backs up and yields start to increase, you'll actually have a capital risk to your bond allocation. So traditionally defensive assets, going back to Craig's first slide when we had bonds protecting assets in times of market distress, what you could actually find is traditionally defensive asset classes are the ones that really underperform when inflation starts to rise. Now, what you're seeing in portfolios as well is a movement in the short term to cash. So we are a little bit overweight cash at the moment, but again, that's more of a short-term defensive play in order to protect the portfolios. What I really don't want to be hearing from clients, I guess, in not so much the immediate short term, but in the mid-term to long term is this is all too hard, or I'm too worried. I'm just going to stick the money in the cash account and just wait things out. We need an allocation to something which is going to outperform and hopefully give some diversification sitting inside the portfolios. And where we'll get that from is the alternate space, particularly in the short and medium term, where you pull the money out of the market. So you de-risk the portfolios from that perspective. We move them into those asset classes which can be more dynamic or will give you a return that sits outside the market, so that when more favourable pricing does come back, and it will come back, we're in an opportunity where we're cashed up, we haven't been exposed, and we can then rotate from those asset classes back into the more traditional asset classes that you're probably more accustomed to. And again, those asset classes should outperform in the longer term.
Gareth, just while we're on that point, do you want to sort of talk more specifically about some of the ideas in the alternative space that you feel are attractive? Yeah, sure. So what we'd really like clients to have a think about now in the sort of mid to or short to mid term is their commodities exposure throughout their portfolios. When you get an explosion of inflation, you want to be tied to real assets, right? One way to do that is through property. Another way to do that is potentially through hard commodities like gold, silver, those types of assets. Another way that we give clients exposure is through market neutral allocations inside the portfolio. So what that means is you get an exposure to market linked assets, but taking the market risk out of those assets. What I mean by that is if you say, for instance, go and buy an ANZ share and the market goes up by 10% for whatever reason, all being said, the ANZ share will probably go up by 10% as well, just to reflect the market dynamic of the market going up. What we want to do
is participate in share upside on shares on the basis of valuation, but strip that market risk out. So if the market falls, we can still have exposure to that asset class and participate in any upside, but try and minimise the downside for clients. Additionally, we're looking at the credit market, the private credit market at the moment, and the ability for that to supply clients with a high quality income stream that's, again, not tied to the bond market, not tied to bank accounts and those types of things. So giving a real return to clients that's in excess of inflation. So if you're retired and you're trying to meet the rising costs of all these things that will go up in value as a result of inflation, you're able to do that. You're able to make your portfolio go up in value, but you can also de-risk the portfolio from a market's asset, from a market allocation perspective. I guess those are probably the three key things that we're looking at the moment. So for those of you that are new to BlueRock, or I guess just need a quick reminder, there's a number of different portfolios and different portfolio styles that we have within the business, catering to different demands of different clients. So we're on a dynamic index portfolio, which is broadly a blend of listed exchange traded funds. One of the main reasons for that is for smaller balances, we can get a huge amount of diversification at low cost. And for those clients that are particularly fee sensitive in regard to underlying investments, that might be a good way of constructing your portfolio as well. For those clients that would like a broader allocation and some active manager allocation sitting inside the portfolios, we have the dynamic portfolio sitting in there as well. What that means is not only can we use the exchange traded funds, we can use listed investment companies, direct shares, manage funds, and leverage some other tools that are not available through that exchange traded fund space. We have the unconstrained portfolio in there as well, which has done remarkably well for clients over the last 12 months. That really is a best ideas portfolio. So it's not for those clients who want a traditional, balanced or high growth style of allocation. What that is you tell us your best ideas and just go on and put our money into the best ideas that you have sitting inside the investment committee. So give us your best 5 to 10 ideas, give us exposure to that. So that's been remarkably popular and remarkably successful for clients. Had a significant amount of outperformance over the last 12 months. Again, we can use a blend of funds, exchange traded funds, listed investment companies, and direct stocks sitting inside the portfolio. Soon to be officially announced, I guess, is the impact portfolio. I'm pretty excited by this, I've got to say. This is a real game changer, I think, out there in the marketplace. So we're really starting to hear a lot more inbound inquiry from clients in regard to portfolios that are socially aware. Now, out there in the marketplace at the moment, those socially aware portfolios tend to be biased on what's called a negative screen. So what that means is the portfolio manager will say, I don't want to be invested in mining, gaming, and maybe alcohol and tobacco. So that's a negative screen. So you're moving those things out of the portfolio, but the manager is typically then free to invest in whatever they want, as long as they don't cover those bases. What BlueRock is doing is actually putting a positive screen over the portfolio, which is where it's a real game changer, I think, out there in the industry. So in that asset allocation where we can actually do social good or social benefit in those underlying investments, we'll take advantage of that. So rather than a don't do this, don't do that sort of style portfolio, it's not only am I investing my money, I'd like to turn that around to the community and hopefully have some sort of social positive come out of those portfolios. So I think that's a real game changer, not only for individuals, but perhaps for charities and that sort of thing as well. And then lastly, we also have the bespoke service, which is for clients who may or may not sit in one or two of those portfolios, perhaps would like to blend them together and then also receive opportunities that sit outside in the marketplace that may be for more sophisticated clients that perhaps wouldn't fit inside those portfolios. So they might be private equity, venture capital, some short-term debt funding options and those sorts of things. So And again, I think that's a really important part of clients' portfolios who want to step outside that more traditional asset allocation inside their wealth creation journey. So, yeah, over to you, Adam.
Thanks, Gareth. I think just the last point to sort of touch on there with the launch of the impact portfolio, it's been something that's been in construction for probably about 6 months and really lined up with the launch of the BlueRock Foundation, which was sort of the main driver of bringing that portfolio to life last year. The BlueRock Foundation launched late last year. There'll be some forthcoming events where we look forward to having some clients back in the office to talk about philanthropy as part of your family's world or your business, and we talk about what BlueRock is doing and how the benefits of that structure can be shared across our client community. So there was a real positive motivation for launching the impact portfolio, and as Gareth said, it's been very well received by our client community and a real push into ESG and impact investing, where sort of 5 to 10 years ago, when you wanted to filter out the bad or try and invest for the good, it really meant sort of sacrificing on the return profile. But certainly, you know, the drive and the demand for investing for good, the development of renewable energies, biotechnology, advancements in medical and technology over the past 5 years has really meant that whole space now offers really strong return potential rather than having to sacrifice the bottom line. So something that we're particularly excited about, seeing that grow as a much bigger part of the investment committee and what happens from an investment point of view going forward. So we don't have a lot of questions coming through. So if there are any questions from the audience, then please feel free to post them in the Q&A function. We might just take one step back in the slides for a sec, Gareth, back to the asset allocation page, because I think this is quite important. Obviously, we've had a very unpredictable period for sort of the last 18 months. If you go back to the start of 2020, we kind of entered that year with a view on what asset classes would perform leading into 2020, and that was obviously turned on its head with the rise of COVID and what that meant for certain sectors underperforming and other sectors performing really well. And one of the things that really threw out fundamentals in the middle of last year, and there's an age-old saying in markets that says, "Don't fight the Fed." The US Federal Reserve basically stepped in sort of April or May last year with an unprecedented amount of stimulus to prop up the financial system globally. I think in the space of 6 weeks, the amount of activity by the US Fed and other central banks around the world was 6 times the amount of what central banks did to bring the global financial system out of the GFC. But it took them 18 months to act in that particular circumstance. So Craig, I'd just be interested in sort of hearing some of your views from an asset allocation point of view. I know we heard a little bit before, but just to kind of wrap it up, just to complement Gareth's comments around how we're positioned and what the thoughts are. But obviously there's some pretty extreme examples there. But at the same time, investors are looking at their Bitcoin wallets or share portfolios and technology portfolios and saying, well, the last 12 months, if you look at the numbers, actually look pretty good. So, what happens going forward? Is it more of the same, or do the fundamentals start to come back into play?
Look, my thoughts are the fundamentals start to come back into play and the valuations really start to matter. It's not so much always a question of looking back for the last 12 months, but it's more a question of looking forward for the next 12 months because you don't tend to see things repeat and continue. So, for example, that point that Gareth made with that fund manager making 100%, it's pretty unusual to see fund managers doing back-to-back 100% years. So my sense is that some of these long-term issues are going to start to become more evident as we move through this year. If we look at equities in the US, we now see a number of variables that we traditionally use to time markets, suggesting that equity markets there are probably in their top 5 or 10%. That's not to say they can't go marginally higher, but For example, things like the perception of individual investors in the US is now the most bullish since 2018 and 2009, 2000 before that. The degree to which investors are buying puts to protect portfolios compared to calls to capture upside is now at the lowest level seen for 10 years. In the US, for example, in the S&P, we now see 97% of US stocks above their 200-week moving average, which is a technical measure that we can use to try and time markets. And we've not seen that since 2000. So, and in all of these cases, all of these extremes have been followed in the following 12 months by declines in the market of between 20 and 50%. So what does that say to us? Well, it says to us, firstly, what should the portfolio be allocated in terms of growth, i.e. equities and growth and equity-like assets relative to defensives. So my bias has been to actually have less growth and more defensives. So that's what the portfolios that I'm suggesting, I think what your portfolios are looking like, a little bit more cautious. As Gareth said, our intent is to protect capital rather than to try and hit for home runs at this point. But as Gareth rightly said, if you look at those bottom 2 or 3 charts there, you can see that with the fixed income outlook being negative, i.e. higher bond yields and higher inflation and a lot higher growth in the very short term for this year, even if the medium to long term looks like lower growth, but still higher inflation, then fixed income is something you want to avoid. So over the course of the last 12 months, Aussie 10-year yields have gone from 0.5 to 1.75. That's essentially meant that if you hold those bonds till maturity, you would have lost about 12% in terms of capital. So essentially an equity-like loss. So we don't, in the defensive asset class, despite the fact that we're overweight, we don't own any bonds. We have more cash. We have things like gold, which should do well in an inflation environment. And we also have on the top right there, things like alternatives that Gareth was talking about. So in that environment, you want to be long market neutral managers. So that's managers with longs and shorts. And they're hoping to make more modest returns of, let's just say, something between 7 and 12% per annum. We also have some other hedge funds, which we think will be making the same sort of return. But also one of the other things that we've got in portfolios and been suggesting are private credit. So that's where instead of owning government bonds, you have managers who allocate credit to small and medium enterprises. And because those medium enterprises don't tend to get access to capital, they're prepared to, and they tend to be high growth, they can afford to pay higher incomes and interest bills in order to be able to get access to capital. And those private credit funds can often make between 5 and 8%. So it's a real case of not trying to hit for the bleachers, but trying to preserve cash. As Gareth said, anticipating corrections will come. And when they do come, then we'll be finding that we'll be far more likely to put money back into equities more broadly to increase that growth weight. The other thing also is within equities and within Australian equities, we have a bias for financial stocks, banks, for example, which I think the portfolios have held by memory for the last 6 or 9 months has worked very, very well. Because banks tend to go up in value when bond yields go up because their net interest margin basically tends to rise. So in the ASX, we have allocations to banks, we have allocations to gold shares, Australian gold shares. In global, things are actually a little bit different from normal. Just recently, we've sharply reduced US equities and in particular tech because we think that area is overdone, but we've increased global value shares. So that's shares that pay good income, good dividends, as Gareth said, businesses that are always going to be around, but they're just unloved at the moment. In addition to that, we've also increased recently, and certainly probably will look at doing so in the next couple of months, more emerging markets exposures, because emerging markets tend to have, firstly, all the growth, all the population growth, still good profits, they're cheaper in valuation terms relative to US equities. And interestingly, even despite the prospects for conflict with the US at some stage. Chinese equities are now the cheapest they've been in 15 years compared to the S&P. So, the story in equities is to have less of them, firstly, but then to tilt to certain markets and certain sectors where we think valuations warrant that.
Yeah, absolutely. I think the message coming through there is whilst certainly there's risks and extremes that exist within investment markets globally, we really need to look for where the opportunities are. The first filter on our list always comes back to protecting capital, which kind of ties into where I'll wrap it up. There's a couple of questions that have come through, which we don't have time to comprehensively answer now. I will certainly take on notice and might add this as an agenda item for our next webinar, which we're planning on rolling these out, I think, quarterly, Gareth, and looking forward to we've got a few lunch sessions coming up as well with individual fund managers and also with Craig to have more in-depth discussions about what's happening around the world from a macro point of view. But a couple of the questions that have come through, which I'll just quickly touch on and then sort of wrap up for the day, is around cryptocurrencies, which I know both Craig and Gareth have views on. And I think we've certainly seen, to your question, Liam, around the performance of Bitcoin and Ethereum, and probably the expense of gold's performance over the last sort of 3 to 6 months, being considered safe havens or a protection against inflation, as kind of fits into that asset allocation page as an alternative. Now, the issue that we've had over previous years, and this kind of touches on your point, Julian, is around the primary goal and objective of the investment committee is to obviously generate return, but protect capital. And fundamentally, the issue is around investing into crypto is around fundamentally what are they worth and how does that play out in a client's portfolio. So it's not to say we don't explore cryptocurrency as part of clients' exposure and blockchain technology, and they're more and more becoming mainstream considerations. However, in the portfolios that we've just presented on the page and the role of the investment committee, those types of exposures sit outside of the hand of the investment committee in terms of running those portfolios with the mindset of protecting capital before chasing return. So it's not to skirt around it. Certainly part of many conversations going on at the moment, and we might leave that one for you, Gareth, to make sure that we add a little segment on our next webinar series to specifically talk about what's happening in the world of crypto and blockchain.
Sure thing.
So thanks everyone for joining us. Conscious that we've run slightly over time. We really value everyone being here with us today. Thank you again to those on the call who are clients of BlueRock and part of our community. For those that aren't yet clients of BlueRock, if you'd like to catch up and have a chat with Gareth and myself or members of the team, we'd love to hear from you. If there's any follow-up questions or feedback, we'd certainly like to hear that as well, because these sessions and what we roll out for our clients are guided by what's of value to you. So have a great day and look forward to catching up soon. Thanks, Gareth and Craig, for your time.
Thank you.